So good afternoon, everybody. For those of you that don't know me, my name's Kelly Cooks and I am the Leisure Director at Advantage. Over the past couple of weeks, we've seen the government come out with lots of new initiatives. So we're hosting this call today and we are partnering with the Travel Trade Consultancy. And this call is all around the business interruption loan scheme. So we'll be talking about what it is, what its aim is, and also how you can start to think about applying for it. This webinar is being recorded and there will be the opportunity to ask questions, which Martin will cover off in a second. So without further ado, I will hand over to Martin and Adam from TTC.
Thanks, Kelly. Hi, everybody. Thanks for joining us. Just before we kick off, just a few housekeeping points to cover off. As Kelly mentioned, so we will be taking questions at the end of the presentation. We think the presentation bit will take something around 30 minutes, and you can type your questions as we go. We're going to focus on the CBILS piece first, and appreciate there'll be lots of queries on lots of other areas of the government announcements and some of the other things you'll have been reading. We'll try and follow up this webinar with a note and some answers to any other questions. And if there's enough demand, or if there are more questions, we're happy to come back and do a round two at some point. Matt's just going to post a link there. If you click on that link and put your email address in and your name and company name, we'll send you a copy of the slides. We'll also follow up with any of those additional questions we don't get around to answering. You'll hear from the presentation that we do know some bits about all of this, but there's a lot that we still don't know, and I guess we'll find out more over the coming weeks. Finally, I've been on enough conference calls with Adam over the last week to know that at some point during this session, one of our children will definitely walk in. It is live TV, so apologies in advance. You have been warned. So I'm going to hand over to Adam first. He's going to cover off a bit more about the detail of the scheme and what we know. I'll come back a bit later and talk in a bit more general terms around business plans and financial modelling and that sort of thing. But for now, over to you, Adam.
Thanks, Martin. Good afternoon, everybody. And Martin, feel free to jump in if I miss anything on this. But what I'm going to cover is a few things, really, just to give you a bit of an overview. There are obviously information that's been released to date. Hopefully, we'll give you a bit more of an insight of what we're certainly seeing. So, firstly, I'll cover off the eligibility criteria. And there are kind of 6 or 7 key things to consider here. Firstly, the loan needs to be for business purposes. Ultimately, most people are going to be looking at this to get them to enable you to potentially trade out of what is a difficult situation at the moment. But it doesn't necessarily just have to be for the working capital. It could be to continue expansion projects. We're seeing some banks saying that, you can continue to use this kind of liquidity to continue to develop your business in the same way as you would, pre-virus, essentially. We've seen the second criteria move somewhat over the last week. I think that the turnover limit was initially 41 million. That's now been shifted to 45 million, with 50% of your trade coming from one activity. That may change over the coming days. I have seen some release that says that's going to be reviewed. I think there is a portion of the businesses that aren't necessarily being captured by putting that cap on it. The third one is you need to be in an eligible sector. Now, thankfully, travel is eligible, but there are some restrictions for fishery and agriculture. You also need to be based in the UK. I think that's a given, really. You also need to be not suitable under the usual lending criteria. I'm not sure that's something that people are necessarily aware of. You will certainly initially be assessed under the lender's usual criteria, and only then, if you don't fit that criteria, will you be considered for CBILS. You also need to have a sound business proposal. That might sound a bit daunting in the current environment, but certainly the bank need to be comfortable that you are going to be viable going forward once this blows over. You also need to be able to demonstrate to the bank that you're going to meet your repayment obligations. They're essentially on risk for a portion of this, and so you need to get them comfortable that you can meet those obligations moving forward. And lastly, this has moved somewhat. It's certainly been taken off of some websites, but there's a state aid maximum of 200,000 euros, and you need to have not received that within the last 2 fiscal years. So that's the eligibility criteria. There may be some other criteria that the individual lenders set, but broadly speaking, that's what we're seeing at the moment. In terms of the actual loan itself, the scheme is effectively being guaranteed up to 80% by the government, as we've seen, and so you'll get a loan. But there are, in between the British Business Bank, who are operating the scheme on behalf of the government, there are a set of lenders in between, effectively. So what that means is that the British Business Bank are giving the guarantee to the lender, and in turn the lender will lend the travel company the money. Some other key features, so you've got a maximum of 5 million over a maximum term of 6 years. As I said, you've got an 80% guarantee from the British Business Bank. They are going to pay your interest and your charges for the first 12 months. And so you get a bit of a holiday initially, whereby you've only got to pay the capital back in that initial 12 months. There is going to be security on the loan, which we'll come to a bit later in another slide. And I think it's important to note that actually, and this is what we've seen on a lot of lenders, but also on the British Business Bank website, is that the borrower, i.e. the travel company, is 100% liable for the loan. So in the first instance, you do remain responsible for 100% of that. So not confusing the 80% guarantee.
Can I just jump in and just make one point? I think this is all government guidance on all of this, but what we know from speaking to some of the banks is that they maybe will set slightly more stringent criteria. So take the 6-year term, for example. I spoke to a bank yesterday who said they won't be offering anything over 5 years, definitely. And even at 5 years, they're considering whether they can do that. So I think it does depend on obviously your business case, but also the particular lender that you happen to be working with.
Yeah, it's also worth mentioning that obviously we're talking about term loans predominantly today, but there are other forms of finance that this guarantee can sit behind. So, overdraft is another common one. You've got some, other factoring type facilities. But what we're also seeing with the lenders that we're speaking to is that actually they're not opting for, or discounting is probably not that interesting to most travel companies. But certainly the overdraft is not something that all the lenders are operating. So it seems to be that most people, or most lenders, are going down just the term loan route as well. I think that's worth noting.
Yeah.
So in terms of who are the accredited lenders, you can see those on the screen now. It's worth have a quick browse here, but certainly checking on the British Bank's website whether your current bank provider is on the list. So mostly because what we're seeing is lenders are prioritising their own customers, and so if you're not with one of those banks, then you're not necessarily going to be at the front of the queue if you're starting or starting a fresh relationship with any of those accredited lenders. So that's really the eligibility and the key features, and also the lenders that are involved and how the scheme works. The next thing really is to determine how much you're going to need to borrow. I appreciate that might be somewhat difficult, but I think there are three key things that you need to be considering at the moment. The first one is essentially how much do you need, and how would you determine that? So there are two key things that you need to be doing. Certainly the lenders are asking, or will ask, to see what your cash flow forecast would look like. But within that cash flow forecast, I would be looking to do some scenario planning just to really work out, and we'll come on to that a bit later in a bit more detail. The second one is how much can you afford to pay back? It's popped up on screen there. So we've got cash flow cover and leverage. Certainly on the cash flow cover side, what we've experienced in the past, and we're expecting some lenders to potentially go down this route, is essentially a cap on how much you can lend based on your free cash. Now, EBITDA could potentially be used as a proxy for free cash. We've seen lenders in the region of requiring or maximising 1.5 times your EBITDA, so that might give you a broader kind of outline as to what the bank think you can afford.
I'm sorry to jump in there. I appreciate on the call we've got a real wide range of knowledge and sized businesses and all that sort of stuff. So do you want to just give a quick sort of overview of what you mean by EBITDA and how you can kind of calculate that?
Yeah, of course. So EBITDA is essentially earnings before interest, tax, depreciation, and amortization. I guess in layman's terms, what that would mean is you would look at your net profit from your last financial statements, or potentially up-to-date management accounts. You start with your net profit or your profit after tax if you've got a tax figure in there, and then you would start to add back certain items, so namely those depreciation, interest, tax, and the amortization, and that would get you to a figure that a lender would say, right, well, we require you to have 1.5 times that amount, and that would be what you'd need as a cash cover. The third thing is this CBILS limit. What we've seen, most of the lenders, I think they're going to all follow this suit. Is really each lender looking at what limit, or again, kind of coming up with an amount that you could potentially borrow. And there are three things that they're looking at here, or we've seen them look at. So one is your liquidity shortfall. And again, that really comes back to your cash flow forecast. What liquidity do you need over the coming months to weather this crisis? The second measure is 2 times your 2019 salaries. Interestingly, so it's gross salaries plus employers' national insurance. Now, I have seen one lender also allow you to include subcontractors as long as they're working on site. Not quite sure how that works in the current environment, given that lots of people work remotely, but that may be up for argument with any particular lender. And the third one is 25% of your 2019 turnover. What initially springs to mind here is that, and it's not clear, and I think will be discussed with any lender, is whether that would mean booking date turnover or departure date turnover. And I think that will be a conversation that needs to be had.
Just one other thing I'd throw in there as well, Adam. I think what is clear is that salaries means salaries, and so a lot of business owners would take out their remuneration in the form of, say, a dividend rather than paying themselves a salary. That wouldn't be included in that figure, which will obviously depress the amount that, in theory, you'd be able to borrow. Yes, and you can't backdate that either. So just as I said, coming on, we've got a graph, I think, coming up on the next slide. So what we've done here is to really think about what a typical summer operator might look like in terms of cash flow, and how you might determine what your trough is and what cash or liquidity you need. So you see here, coming through January, cash starts to build. Then you might have some Easter departures, and so cash takes a dip, but then starts to build back up to the summer, and then that plays out over the rest of the year as those departures effectively depart over that summer period. Now, what's actually happened for a lot of businesses, I'm sure, is this new dotted line, which is said virus. And so a lot of people's cash flows have taken quite a significant hit in the last few weeks. And really what you're looking to do, and I appreciate this might be difficult because lots of people are trying to either postpone instead of refund, but maybe forced to refund in some situations. So you might not be quite sure what cash is going to go out of the business over the coming weeks and months, but certainly I'd be looking to plot out what you expect to be reasonable, and hopefully that would give you an idea, as you see this orange line pop up on the screen now. Hopefully that would give you an idea of where the trough is. So obviously that would be a liquidity shortfall. Borrowing that amount would take you to zero, but really no business wants to operate at zero. There'll be some assumptions in there that may ring true. There may be some upside, there may be some downside. It's really not clear for a lot of people at the moment. And so what I would do is look to come up with, an amount over and above that would allow you to have some flexibility in there, but bearing in mind the affordability side of things as well. So I think it's going to be quite a balancing act for a lot of people, but certainly something, given your business, how the profile usually works, what you're expecting. I appreciate no one's got a crystal ball, so we don't know when this is going to end, but a lot of people are saying maybe it will come back in September. So if you can plot something like that out, I think, bearing in mind other things, also, there are lots of measures coming in. So actually maybe your cost base will be reduced if you've not reduced that already.
And so really just trying to understand what that cash profile might look like, plus a surplus to that to help you get through an uncertain time. So I think I alluded to this earlier. Security, there is going to be security on any loan. I think it was unclear a few days ago, but certainly has become a lot clearer for us now. And there are really kind of two camps that we're seeing. One is less than 250,000 of borrowing. And if you're borrowing less than 250,000, a lot of the lenders are going straight for a personal guarantee and a debenture over the company as well. I think it's important to say that with the personal guarantee is often quite scary for people, and that's understandable. It's not ideal, I don't think, but they can't. It's written in the scheme rules that the personal guarantee does not include your personal private residence, but it will potentially include other personal assets. If in the event you couldn't afford to pay the loan back. Over and above 250,000, it really becomes a bit more case by case. You might have some assets in the business that they could take a charge over, any premises, etc. But again, there would be a debenture in place as well over the business. I don't know if you want to say anything on that, Martin.
No, I think you've covered it, Adam. We're going to cover a bit more in detail about the business plan and what that needs to look like, and that will draw out some of the other things that we'll need to articulate.
Yeah, sure, no problem. Okay, so hopefully that gives you a bit of an idea as to how much you need to borrow. I think when you're considering how much it is you need to borrow, you also need to consider some of these guys on the screen now. Fully appreciate that actually it might not be your first consideration, because it's really about survival at the moment, to be quite frank. But I think at least at the back of your mind, you need to be thinking about, well, if I take on this borrowing, it's certainly going to affect my balance sheet. Company's house is going to have a fixed and floating charge, debenture registered there, so that will be picked up by membership organisations and licensed. So I think it's important just to consider what that means coming down the road and how that might affect your business and the balance sheet, but also affect your relationship with some of those people. As I said, I appreciate it might not be at the forefront of your mind.
Yeah, I'd echo that. And actually, conversation with the CAA, we're speaking to them regularly at the moment, and off the record, they're saying the same thing. Right now it's about survival. If you have to do something which maybe causes a sort of deterioration in the balance sheet down the line, but it gets liquidity into the business, then you've got to do it and deal with the consequences later. You would hope, and the tone coming from the regulators, ABTA as well, is a bit more forgiving, and even IATA have put something out that says they're considering relaxing reporting rules. IATA's definition of relaxing is like a week, that you get an extra week to submit your accounts or whatever, but at least it's a step in the right direction.
I think what we're seeing from travel companies, but also suppliers and the industry wide, as everyone's coming together, I feel like the regulators are on board somewhat. Hopefully it stays that way.
Okay, thanks, Adam. So I wanted to spend, I guess, the next 10 minutes just talking about business plans and financial models in a bit more detail, just to give some ideas, because again, I do appreciate there's a real wide range of businesses on the call. Some more sophisticated than others, some with more resources and more experience of doing this sort of thing. So we'll just sort of cover off the key points. I think firstly, it's worth remembering that, business plans can fulfill lots of different functions. And this business plan is solely to give the bank confidence to lend you money. So you start with that in mind. And I think just wanted to spend a couple of seconds talking about how banks typically would look at the credit assessment process. They use this model, the 5 C's. I think over the last decade, we've come to realize there's lots of C's in banking, but we're only looking at these 5 today. And effectively, you go through each of those. So firstly, character. What's the credit history? What's the management experience? As the size of the loan increases, certainly what's the financial skills within the business to be able to manage a business to things like banking covenants and repayment plans. They'll want to get some comfort over the owner's contribution, and not really, the owners need to be able to demonstrate they've got some skin in the game. I mean, when we do this, take coronavirus away for a second, whenever a bank is looking to lend, they really want to get a sense that everybody's in this together, not necessarily as equal partners, but they want to see that the owners have put something down as well. So that could look like, we'll lend you X if you put Y back in, or you take away some of your salary. But what they don't want to be seen as is they're the only one taking a risk, in effect. Capacity is covering some of what Adam's just talked about there, really. Ultimately, it comes down to can you afford to pay it back? There's a variety of different ways you could look at that, but ultimately it's, can you service that? When you look at a normalized business, once you recover from the other, out of the other end of the crisis, is your business generating enough cash to be able to repay them? Collateral, we talked about, travel, generally speaking, travel businesses don't have a huge amount of assets lying about for collateral. So usually that does come down to either blocks on cash, personal guarantees, those sorts of things. But ultimately the bank is looking at what they can get. And then I suppose that the sort of make weight on all of that is the conditions that they set. So that will be the price that you pay, the interest rates, the fees and charges and that sort of thing, together with what kind of covenants and reporting obligations they put in place. So all of those sort of hang together as in how the bank assess your business and your case and decide whether they're going to loan you money. I think for the purpose of this loan, though, you could probably sort of summarize it as, would they have loaned you the money this time last year? And we've heard from a number of banks already that that's basically how they're going to judge it. Is they're going to almost rewind the clock back to January 2019 and look at how your business played out and try to decide if you'd come to them at that stage, would they have considered you? I think when you're writing a business plan, again, it kind of goes without saying that there's a scale of complexity and detail, and that really is determined by how much you're looking to borrow. So, broadly speaking, you could look at loans of order of magnitude 50,000, 500,000 and 5 million within the scheme. And they're all just obviously indicative. But if you're looking to borrow something of that order of 50,000, then it's a pretty simple business plan. It's down to some historic financials, a basic cash flow forecast, which we'll come on to what that maybe means in a second. Some detail on what you've done in the business to try to cut costs and try to mitigate the situation, take advantage of some of the other government funding options and that sort of thing. You'll need to have some detail in there on what your recovery assumptions are, and they've obviously got to be reasonable. We'll just try and give a sense of what that is, but ultimately there are no right answers on that. It's just you have to put something that I guess feels sensible given what we know about the general conditions. And then some supporting commentary that backs all of that up. But I don't think you're talking about a lot of sophistication there. It's pretty basic. You step up to the next sort of sized order of magnitude, I think you'd be looking at something a bit more detailed. So certainly all of that stuff we've just mentioned, but maybe a bit more detail. The bank would want to know a bit more about your business, the product range, the model, how you distribute product, what the kind of different margins are for different divisions of your business. They'd want to know a bit more about your management team and the skills and experience, so maybe they'd ask for CVs and that sort of thing. And then you step up to something much more sophisticated, I think, when you're looking at this end. And again, my sense is there's probably not a huge amount of people on this call who are looking at that end, but certainly you can imagine a lot more detail, a lot more sophistication in the financial model, certainly around scenario planning, working capital analysis, sensitivity analysis, and all that sort of stuff. I think just to sort of summarize, though, the kinds of things, just as a crib sheet, really, the kind of things I would be looking to put in the business plan, really, an executive summary where everything is sort of brought together, but a bit of detail. Really, we're looking probably somewhere between the on that last chart, somewhere between the 50,000 and 500,000 level. These are the sorts of sections, that I think you'd want to cover off. And the level of detail that you go into on all of those, again, it depends on really the simplicity of your model. But as a sort of crib sheet, there are the sort of sections. And then just to give an indication, I mean, here's a redacted version of a model we prepared for a client. And this is the kind of commentary, I think, in a simple business plan, this is the kind of commentary they'd be looking for. So here you've got a chart showing the overheads of the business for the last financial year, and just a sentence or two about each one. and what's in there and what's the breakdown. Similarly, we've got a profit bridge here, so that's showing how you got from their 2018-19 EBITDA to the current year, and it's just a summary of the kind of differences we'd expect, along with just a bit of commentary. So I think at a basic business plan level, that's probably all you'd be looking for. I think as you start to get more complex, clearly you would want to, the banks, the lenders would want to go into a bit more detail on some of that stuff. I think I just sort of summarized that business plan section really by saying, obviously, this is about giving them confidence. And I think it's important to note that usually the way banks and lenders work is you will have a relationship manager. They want to loan money to you. They really do. But they have a credit committee internally that they have to get comfortable to ultimately sign off the loan. It's not necessarily their decision. So you need to think about, go back to those 5 C's that we talked about at the start. You need to think about how you arm your relationship manager with the skills and the questions or the answers to the questions he's most likely to be asked. But almost see that relationship manager as on your side. How do you put them into bat with all the tools necessary to get a credit committee to approve that loan? So it's around demonstrating why your business is strong and it's coronavirus that's caused the problem. It's not underlying issues that, you know, as I say, go back to 2019, the bank wouldn't have considered you for a loan anyway. I really think you've got to spend time articulating what you've done already to mitigate the risk, how you've negotiated, you know, with your landlords, or you've cut costs or whatever. And I think this showing some skin in the game piece, I think that's where you maybe can be a bit more creative. You need to just think of a way that you can demonstrate to the bank that you're taking a risk, you're not putting all of this risk onto the lender. But I think probably most importantly, and we'll get into this in a second, I think you've got to be really careful about the rebound assumptions. You know, we speak to banks a lot who say every business plan that comes across their desk explains how this fantastic business is going to, you know, hockey stick, and it's going to grow exponentially. And I think they're just so, not just in travel, across all sectors, so sort of jaundiced by this over-optimism. And I know travel probably has generally more optimism than many other sectors. But really what they are trying to answer, and the question that their credit committee are asking to them is, but what if it doesn't? What if it goes wrong? How do we get our money back? And so that's why ultimately assumptions have to be sensible. The best thing to do, I think, is to try to illustrate what are the levers you could pull further down the line if there's, you know, no further changes. Ultimately how you can protect the bank is probably the way to look at it. Just spend a few minutes talking about financial models, because conscious of time. Again, think in the same way as before. Really, the sophistication and complexity of the financial model really is determined by how much you're looking to borrow. I would assume probably most people on the call are again in that sort of simple or intermediate. We won't talk about detail, because I think, frankly, if you are looking for that sort of amount of money, you either will already have internal resources to do a lot of this stuff, or you know, you probably should either get them or get some advisors in to do it, because it's obviously a lot more complicated. But I just wanted to talk through maybe how you might think about producing a simple model. I'm going to do, against my better judgment, a quick sort of live overview of just a few thoughts we pulled together. I'm not going to build a model from scratch, because, you know, Excel building isn't really a spectator sport, but here's just a few thoughts on, again, for a simple business simple model looking to borrow that sort of 50,000 or that order of magnitude. I really think it's a one-page Excel sheet. It's probably what we've got here is months along the top. You've got the actuals, A for actuals up to, in this case, February. Then we're going on to the forecast for March. We've got all of our actuals in here. So this is showing just a simple net trading income. This is predominantly aimed at a travel agency type business. Net trading income, and that, again, that's actuals month on month. You've got your cash outflows for all of your major costs, like your salaries and that sort of thing. Getting down to what is your net cash inflow and outflow on that row there, and then opening cash and closing cash. And so then I think you go forward, you've got your actuals in this case up to the end of February. This area shaded here is really the current position we find ourselves in, and this is really, I think, where the assumptions around intake and income, I guess, are zero for most people. I can't imagine there's too many people taking bookings, maybe even negative given the refunding type scenario. These lines here really are around what action you can take now to cut salaries and to take advantage of some of the other help available, really, and negotiating down on rents and various cost cutting measures. And then just a few things that I'd sort of point out. I mean, the way I would approach it. So what I've done in this version is effectively cut out all sales for 4-month period. Again, you could argue whether 4 months is enough. Maybe it's 6 months. But I've started to build in the intake. So as the sales build up, we're not expecting that suddenly we're all allowed out of our houses and we start booking holidays again straight away. I guess the reality is, different countries will kind of come back online at different times. Maybe it's domestic travel comes back more quickly than overseas. I guess, again, there's no right answers on any of that. The bank doesn't have any right answers. It's just really what you think is sensible. So what I've done here is a sort of recovery rate based on the same month last year. So this is saying basically in July 2020, we think we'll take about 5% of the bookings we took in July 19. By August, maybe people are a bit more confident. We might take 10, 15, 20, etc. And it's not until we get to February that we're back up to 100% of the previous, the sort of February 19 type run rate. I think similarly, you could do the same with costs. If you've had to take action to reduce your headcount or furlough some staff or whatever, maybe those costs stay low all the way back until you get back to sort of 100%. The bank is clearly going to say, well, if you're still expecting you've only got 10% of your headcount costs, but you're making 100% of the sales, there'll be a sense check piece going on there. And so all of that flows through to what is the cash gap. I've let me just delete that for a second. You'd see that without that loan, this shows me that the trough of my cash position based on those assumptions is £57,000. So what I've done there is just stuck in, let's say we apply for a 60,000 loan. You can see that drops you down to a low point of now 2,000, which take into account what Adam said before. You might think that's not enough. You might also look at this skin in the game point as the shareholder. You might have, say, 10,000 to put in yourself, and the bank might actually ask you to do something along those lines just to demonstrate a bit of extra headroom. The important thing to model, though, I think, is this bit in grey here. I've run this model out to the end of December 21, because whatever you borrow in the heart of this current crisis, you're going to need to pay back, and you're going to need to understand what the impact of that payback is. So here we've got it's a 5-year loan, but we don't pay back anything in the first year. So effectively, years 2 through to 5, we're paying 100% of the loan back. So there's also an interest cost. You need to factor that in and just, I guess, confirm to the bank that the cash flows of the business by the time you get back to normal would be sufficient to cope with that. So I think that, to me, something like that, a one-page summary would be adequate for those sort of smaller lends. And you can be more or less sophisticated than that, but that's kind of what I would be thinking about. I think when things start to get, you're looking to borrow more and you need to be a bit more sophisticated, you maybe start looking at, I won't go into too much detail, but things like intake plans. So you might have seen this before, but this is saying, bookings are taken January. When do they depart? And so this is telling me 2% of them will depart in January, 25% in July, etc. You apply those sorts of percentages to the historic data, and you maybe start to play around with, well, what is the change in travel habits? If no one's been away in the summer, do we actually get a big peak of winter departures? That's a degree of sophistication on from what you just saw in that simple cash flow. And I think just another idea is a more kind of marketing-led build-up. So rather than in where you can see in the simple cash flow, we've just gone with this net trading income balance, which is effectively historics, and then we're just assuming that at some point we get back to that historics. So the marketing-led plan might look something like this, where you say, it's going to depend on your business model, but in this case, footfall. So this is saying, let's say we get 100 people come into our shop. We know the conversion rate from footfall to inquiry is roughly 70%. So we'll get 70 inquiries. 25% of those inquiries go through to booking, average booking values. That you take a 10% commission on that. which means that that's our income, and you can build that out. You can flex it. You can flex the assumptions around conversions and that sort of thing. Again, it's a degree of sophistication on from that simple model, but it's still not beyond most people. And actually, what you could look at is if you've got a business that's selling online as well as having people coming in store, you can look at different assumptions for different levels. I think as you get up that curve and you're looking to borrow more money, the bank is going to expect you to be a bit more capable of monitoring and managing to those sort of metrics and tracking KPIs and those sorts of things. But as I say, that really is going to depend on your business and on the particular case. So I think that's pretty much all I was going to cover off. Just put some other notes on. Just put some other notes on the intermediate there, and just some ideas around how you might think about that building up of the sales forecasts. I think the thing always with financial modelling is there is no such thing as a template business. Every business is different, and so it is quite difficult to give out a template model. Always happy to have a chat through the kinds of things we think. I mean, I would say start with what are those key drivers for your own business, and then sort of build the forecast off that. But always happy to give a view. As I say, we talked about could we prepare an off-the-shelf model that we just give out to everyone, but the reality is it always needs a degree of customization. So happy to share that file there, and happy to have conversations and answer questions where we can. We're going to hand back to Kelly for questions. I think just wanted to sort of wrap up on this and say we feel free to click on that form and give us your email address. We'll send you this slide deck, as well as happy to send over that Excel model. It's a bit scrappy, but it might give you some ideas. Equally, as we're going through this, and generally we as a business we put all of our sources and interesting documents coming across our desk, we stick up on our LinkedIn page, both Adam and my own personal LinkedIn, but also the company one. And then on our website, we're posting blogs and sort of think pieces and that sort of thing. But any questions, happy to take them right now. I'll pass back over to Kelly, and thanks for listening.
Okay, thanks very much. Really useful. We do have some questions that have come in already, and we had some beforehand, so we'll aim to get through as many of these as possible and really grill you both. So the first one is around new businesses. So, for example, if you're a new business that has been trading for 6 months or less, are they still able to apply for this scheme? And if they are, there's a concern around not having enough historical information on how well the business was performing prior to the outbreak. What should they do?
So I'll take that one, if that's all right, Martin. We've seen this. It's not really evident in the public information yet, but what we've seen with one lender is certainly in the criteria. So when I was speaking earlier, they were looking at 2 times salaries and 25% of 2019 turnover. Now, if you've been trading less than the 12 months, it's not that you can't get access to this loan, but you'll need to look at, I think this particular lender wanted an 18-month projection. So instead of basing the criteria on the past 12 months, they'll look at the next 12 or 18 months that you've predicted based on current trends, and then the criteria will be based around that. So yes, it is possible. But you need to have a bit more of a forward-looking position that they would analyse as opposed to historics.
I think that the point I would add as well, and it's more relevant for startups and businesses without that track record, but actually it's relevant for everyone. And look, we're all stuck indoors. I had a conversation with a relationship manager at one of the banks on that list yesterday. He's helpfully trying to give me information, but he's got his 1-year-old screaming in his ear. He's got his 3-year-old screaming for his lunch. Actually, if you in these sorts of scenarios, you need to make their life as easy as possible. And so it really comes down to the quality of the application and the quality of the information. The better the business plan, the more robust the model. I think if you're a smaller business, you can kind of, or a business without that track record, you have to, the make weight becomes the quality of the information. And if you've got a much better proposal, that's easy for him, with baby in hand and sort of all that sort of stress going on, to be able to just pass it through. Yeah, that's an easy no-brainer. We'll definitely lend to that business. You stand yourself a much better chance. And the flip side, it could be a very good quality business, but either you don't have a relationship manager, or you haven't put the time into the application. You'll be bottom of the pile. And the banks are saying they're going to try and turn these things around in 7 days, but everyone we speak to is saying it's there's so much demand for it. It's just going to be really hard to get through them. That would be my advice: is just really focus on that quality of application.
Okay, great, thank you. Okay, next question. We've had a couple of questions actually around businesses that have larger turnover. What would be your advice in terms of availability of loans for those larger businesses?
Certainly, go on, Martin.
After you, Adam.
Okay, so we've seen this move from 41 million up to 45. We do understand it is being reviewed, and so in the coming days and weeks, I might expect that to increase further. But as it stands under this scheme, you wouldn't qualify. So I would be then looking to lean on some of the other grants, etc., and the furloughing that are coming through in the next few weeks, which will hopefully help the business as well.
Okay, thank you. So next question is around consolidation of loans as part of this scheme. So as far as you know, would banks be open to allowing companies to consolidate loans under this scheme if it saves the company a significant amount?
Well, I think maybe let Adam jump in here, but I think it comes down to really how this is set up. And look, it's probably not what a lot of people want to hear, but I do feel like there's a disconnect between the headline grabbing what's being said by the Chancellor in these presentations and then what we're hearing at the front line from the banks. Because actually, if you're a business already with a loan, what we're being told is that the banks firstly are looking to lend to you as a normal applicant, and it's only if they can't that they'll fall back onto this scheme. So I guess if you've already got a loan, you already have to take into account servicing that loan. So like any other time when you're looking to refinance, I guess it's an option as long as you can demonstrate that the additional amount you're borrowing, you can look to try and push out the payback of that up to the 5 years. Let's say you're kind of 3 years into a 5-year loan. To me, it would be fairly straightforward, subject to the financial assessment, for a bank to push that out to 5 years, either give you additional amount to draw down on, as long as you can demonstrate that affordability piece. But if you're 2 months into a 5-year loan and you've already borrowed the maximum amount that bank was willing to lend to you based on your financial situation, your leverage multiple or your cash flow cover or whatever the metric might be, it's going to be hard for them to justify being able to loan even more to you, I think.
Yeah, I think that I agree with that. If current lending is with your current bank provider as well, that may make this process slightly easier. I think there are some scheme restrictions, although that's not entirely clear, just coming out the other side of this CBILS scheme. And so I wonder whether this person if the loan is under the previous scheme, the EFG scheme, that may have some difficulties. But certainly I don't see why it should be a problem, as Martin said.
Okay, great. We've got a couple of questions around some of the other government schemes that are available, so I'll just throw a couple of those in as well. So first one is around the rateable values. So if the retail premises that I occupy is new and doesn't have a rateable value currently, does that exclude them from qualifying for the cash grants or the small business grant funding?
I'll be honest, that's I'd have to take that one away, but happy to do so. I think with the current guidance, it's not quite clear. Certainly on that, the local authorities are not being guided until the 1st of April. And so we've got a broad criteria at the moment, but that may become a bit clearer next week. So happy to take that one away and do a bit of digging on that one.
Great, thank you. And then going back to the spreadsheet that you used as part of your deck, I had a question through on that and whether businesses should include payroll forecasts based on furloughing staff or not doing so when they're doing that for their banks.
Yeah, I would say you need to illustrate what action you're taking, and so I would certainly show the impact of that in the numbers, but in the commentary, I would explain that that's what you've done, and I guess the financial model would then show that cost coming back into the business around the same time as the business starts to recover. But yes, and that's exactly what the bank is looking for. As I said before, I think they'll be very reluctant to loan to a business who is where the bank has been the first port of call. Now, I know nobody would do that in practice. Everybody, I guess, is reluctant to take on debt, and it is being seen as a bit of a last resort. But the bank want to see that you've kind of cut what you can and gone through a bit of the difficult decisions, and then they'll kind of come in and top up in effect.
Yeah, certainly we're on application forms that I've seen, they specifically ask what measures you've taken, but also what government initiatives you're using. So I would certainly or definitely include furloughing in your plans.
Okay, brilliant, thank you. We've had quite a few questions in around the grants and where travel businesses are definitely included in the retail, hospitality and leisure grant. And also, can you apply for that plus the small business grant funding?
That's a good question. It's not clear on the definition that they've used in terms of leisure and hospitality. Certainly it looks so if you've got a retail shop, but if you don't, it's not quite clear. So the £10,000 grant is not specific to those sectors, but the larger grants, I'm not quite clear on the definition. So I think for me that remains to be seen at the moment. Have I cut off?
We might have lost Kelly there, I think.
Okay. Wasn't sure whether it was me or Kelly.
I don't know if, Matt, if you're able to jump in and take over any additional questions, or David.
Yeah, sure, no problem. So obviously Mike's re-put the question on there, Adam, so we can go back to him on that. Oh,
yes. Yeah, okay.
Okay.
If Mike just gives us his details on that form, that would be great, and then I'll happily look into that.
Yeah, Mike, I've got your email address here, so that's fine. Right. Do we know for sure if the grant is per business or per business location? But that's what we're going to follow up then, isn't it, with Mike there as well? Any news on the business rate grants where the rateable value is over 51k?
Unfortunately, not at this stage, no. But we'll keep an eye on it. So I can see actually that's anonymous. But again, if somebody wants to, or that person wants to put their details in, we'll happily follow up once we have more information.
What I would say is that I think that's the answer, and unfortunately the case with a lot of these additional schemes is that there just isn't the details available yet, and we really have to see how this CBILS has been rushed out, I think, and is a lot more advanced than some of the others, but there are a lot of these questions around applicability and exactly when it will take effect. That's certainly what we're seeing.
Yeah, I think that's right. Even some of the lenders, their websites are changing from day to day at the moment. So you 1 minute you think you're following certain criteria, the next minute there's some small changes to the detail. So it is a moving target for sure.
Okay, great. And Kelly's back. So is she back? No.
I am back, but the questions are not popping up. So if you could carry on, Matt, that would be great, please.
Yeah. Well, I think that's all we've got in terms of questions at the moment. Unless anyone else has got anything they wish to add.
Well, I mean, I think if there's no further questions, we'll send round this deck, which is a good starter, and just a few things to think about. But inevitably, as we have more conversations with banks on specific cases, and also just, we're having general catch-ups with as many of the lenders, the accredited lenders, as we can. And I think we'll start to see, this was meant to be out on Monday. Actually, it was probably late Tuesday, wasn't it, by the time we actually started to get any detail. We're only 24 hours on from that. So I think it really is too early to say whether, for example, they are sticking to the 7 days. We're hearing stories of people saying, you call your relationship manager and they say, I want to make an application. They say, how much money have you got in the bank? Sorry, you've got too much. You're not a priority. There's people who are running out of cash by next week, and we're focusing on them. So I think there's a lot we need to learn to understand what the practicalities are of applying for these schemes. But we're happy to continue just feeding back and answering any of those questions that are left outstanding. But as I say, we'll filter more information through as and when it becomes available.
Great. Thank you. Well, I certainly found that really useful. I'm sure that everybody did. So thank you very much for your time and for all of the information, and we'll make sure that we do filter that out to everybody that has left us details. So thank you very much.
Brilliant. All right. Thanks, everyone.
Thanks, everybody.